Yes, I sent you two charts on the Dow Jones. If we take a look, then people can see what the outlook is and what's going on. This is a weekly Dow Jones industrial chart, it says. And right at the top, before this thing came down, you see there are three cycles on the bottom. That's our timing model. The cursor is right at the top, and you can read it on the left side. It says 19th of November 21. That's what went out. Now, these are cycles that longer-term weekly cycles that rule the stock market. Sometimes they're up, sometimes they're down. So I have a special model developed that comes up with the end result. But this was very clear because all three, as you can see where the cursor is, were topping at the same time. And the last time we saw that, if you go all the way to the left, was at 2006. They were also toppling just on the left side of the chart. You can call it the crash from 2006, 7, 8. It was the last time when all three were topping. So I have been publishing that at least it should be the same situation, maybe worse, because we have the same configuration of the cycles. So we totally went out of the market in November. And what I wrote is, and maybe you have the short-term Dow Jones chart that I sent you. So it says the daily now is bottoming around the 5th, 6th of May. But we had on the NASDAQ, we had a downside price target when this whole down move started of 12,200. I think yesterday the close was 12,201. So that was good enough. So if I don't get lower price targets and the short-term cycle now leads to a bounce, what I wrote is people who did not get out use the bounce in the next couple of weeks to get out, because after the summer or in the summer, I just have to calculate, it's going to go down a lot again. And you'll be sorry. I know you should have gone out in November, but you will be sorry if you don't use the next bounce to get out. So it's not to get out now. First, we'll see if this daily cycle can do something, because the weekly cycles are so strong on the downside. So we're looking for a bounce, and then I will time it. And then it's another chance to sell some stocks if you're still in the market.
So a couple of questions. When you say if you don't get more downside targets, so you got a 12,200 went to 12,201. So if you get another downside target, that's going to tell you we're not going to get this bounce and it's going to continue going. Is that correct?
No, we get the bounce from a lower level. So let me explain it like this. It's like you're sitting in a subway and you know where the stations are. So it's going to stop in 34th Street, and if not, the next one is 42nd Street. So it's not that it's going to stop somewhere in the middle. We know exactly what the price targets are, and we know exactly if it doesn't really hold around 12,200, where the next downside price target. So everything is actually mathematical and calculated from the beginning. It makes investing very, very simple. But the major thing with my system is, if you're not a real speculator or a day trader, as you know, we have also intraday updates that tell you exactly what hour the market goes up and how much it goes up that day. But if you're not, then you take the weekly cycles, and then you make sure that when the cycles stop, you sell, and when the cycles bottom, you buy. And that keeps you out of trouble and takes out all the emotions out of investing.
So you would say, let me go back to this last chart on the Dow Jones weekly. So this is what we're talking about. So when you give a target in your research and say my target on the upside is 34,000 on the Dow, when it hits 34,000, then we should start removing some of our profits. Is that correct? Should start to sell?
Yes, I don't think we'll get there, but if you follow my research, then you stay in until the cycle tops again. So we're talking about the short-term cycle that I just showed you, but it's going up against the weekly cycle, so it's going to be very difficult to get a good bounce going.
When you say that it's very, very similar to the 2007, well, that was a really, really tough period to be an investor in any asset classes, let alone be someone who's working. So these three cycles are what's dominating the Dow Jones. Is that correct?
Yes, but if you look at the numbers, this is actually worse than what we said in 2007, 2008. The amount of percentage that went down for the first 4 months, 5 months almost, is the biggest one in the last 80 years. Wow. So we're already down, I don't know, NASDAQ 25% or so. My target was going down 40% in 2008, which we did. So if this is the beginning, then it's going to be a difficult time ahead.
So you think you might exceed 40% down on a NASDAQ or Dow? Have you got any targets for that?
No, but very long term, this down move can go down for a year and a half, 2 years. So can you imagine?
Yeah, I can imagine. I lived through the 2008, 2009. We all lived through it, but it wasn't always the most pleasant time. So what you're seeing is the same pattern that we're having in both of these cycles. Is that correct? And then
actually, I can make a case that if you're a fundamental investor, you're always too late, because now I can say, listen, the GDP is very low or negative. The inflation is very high. Of course, it's bad for stocks, but that wasn't in the media in November last year when we went out. So what I try to educate people is that don't wait for the news. You're always going to be too late. They're probably insiders who know already a year in advance what's going to happen. And based on cycles, because a lot of big firms use my work and they're all going to sell. And if you wait till the media pick it up. So today on CNBC was interesting because I have some people who covered all the shorts around 4,000 on the S&P because there was a price target. And it says now what they're going to say is don't buy because it could be a bear trap. So first they keep everybody in. And now if there's a chance to see a bounce, it says don't buy it because it could be a bear trap. So they're always on the wrong side. So until they wake up, it's already 20 or 30% lower. So don't listen to all this media. Just watch our research. And it makes life very, very bearable being an investor.
Well, let me go to that daily chart then, if I can.
Yes.
And so this bounce that we're talking about is this right here. So you've got the date was 5/5. That was 3-4 days ago.
Yeah.
It bottomed, and you're talking about this bounce right here. Is there a way to quantify that as to how long this is going to be? How much up move we're going to get?
Well, it's like I have to see the first up move, and then I can calculate the momentum, and then I know how high we go. But as long as it goes down, I cannot get an upward price target. And where that cycle exactly tops, I don't know. I think it's somewhere in June or so.
So 3 or 4 weeks then maybe.
Yeah. So we should take advantage. So actually, as you look at the bottom and the top, the Dow Jones, you see actually this hit every top and every bottom. So it's pretty reliable, this daily cycle.
Well, that's wonderful news. And if they pay attention to this, then they can probably, if they haven't gotten out, this is going to give them an opportunity to get out at a little higher prices. You know, oftentimes it's having cash to take advantage of these opportunities. If you don't sell, you don't have cash to do these things. And Charles, this is your longer term interest rates. Now, you and I talked about this actually. You know, I listened. You talked. I listened. Last November 2020, when you were very, very emphatic that interest rates were heading up. You can see them on your chart. They've been heading up for a little while, but you said it was time to get out of the bond market. And you said that when you and I had our interview. And look what happened in the first quarter of 2022. It's just hard to imagine. It was the worst quarter in 157 years for bond.
I've been writing for the last 2 years. We went out at the high. Bonds were trading at 190 or so, and now they're 135. Wow. And I had back discussion. I said, listen, it has been a bull market for 40 years, and you get less than 1%, and inflation is 1%. If you think it's always going to be like that, stay in bonds, but it's definitely not going to stay. You just fell asleep because the bull market has been there for 40 years. Now, the amount of money that has been lost by institutions and pension funds is tremendous because there are much more people in bonds than in stocks still. And I show here the trend line that we have been watching for the last couple of years. And as you see, is now it's trading above the trend line. So this is a major break on the upside.
So do you have an idea how high this is going to go for? This interest rates that you and I have talked about is an extremely long cycle. This is a 35 or 40-year cycle. So
right.
Do you know how in what time frame we're going to get an increase in the rates? I mean, are we looking at going to 10 to 12% in the next 2 or 3 years?
Yes, definitely. Very short term, I didn't publish it yet. The inflation is going to be a little bit less for the next couple of months. It's interesting. When I say inflation is coming, people say no. When I say it's going to top, people say no. It's always the other way around. So for now, And that's one of the reasons we're now seeing a rally in the bond markets, which we went long a couple of days ago. We have seen a short-term top in inflation, but this is a situation that is going to be there for the next 30 years. So give it some time, and we definitely will go as high as in the 80s and probably worse.
So, we've enjoyed inflation under 2% here in the United States since the year 2000, basically under 2%. Do you think for the next 20 or 30 years we're going to be way above that in inflation?
Way above that, especially because of the situation with the money printing, and it had to go wrong one time, and everybody postponed it. Every Fed governor says, not in my lifetime. It started with Greenspan, and not in my time, and they push it forward so they will not go into history having a bad name. But now there's not much to do anymore. The very strange things going on, like the European Central Bank still has interest rates almost around zero with this inflation. Nobody seems to know how to fix this anymore. So it's going to be a big problem. And one of the problems is that they have no idea about cycles. They have no idea about long-term outlook. And even the Fed says, well, we'll take a look at the next month's numbers or the next meeting. And I don't understand that. What kind of a forecasting is that? Now, I have a hunch, I don't know if that's the right word, as you know, from Amsterdam, that they don't mind having inflation because, as you know, the United States owes a lot of money. And I once made a calculation. The same thing happened in the time of Roosevelt. And in the end, in the late 40s, actually they paid back only 10 cents on the dollar. So if there's going to be a lot of inflation, that's the way to get out of the debt. Because as long as there's no inflation, you have to pay back everything. So I don't think they mind the inflation.
Well, that brings up a really good point, because then what's the implication of long-term inflation, high long-term inflation? So if we're talking about inflation, really, we're not talking about a spike. We're talking about something that's going to be into the system itself, that's going to be with us for long term. Then we probably need to start, maybe there's going to be a shift from financial assets to tangible assets. So maybe people really need to start getting into things that are real rather than tangible, so that they can hedge their inflation, I would guess. And same with protecting their purchasing power. Is that correct?
Well, there's not much you can do. Like I wrote, there's nowhere to hide at the moment. I think we saw a top in real estate. You don't want to be in the bond market. You don't want to be in the stock market. It's too early for gold and silver. You don't want to be in cryptocurrencies. There's nowhere to hide. So I know you lose money because the inflation if you're in cash, but cash is king, like they say at this moment.
You're probably going to, sometimes it's nice to be in cash for a short term, but I'm talking about, if you're talking 5, 10, 15, 20 years of inflation, that's going to change your outlook for your investing on a long term, because you can't really look at things that are financial. You can do it maybe on a short term, but bonds would certainly be a terrible, terrible place to be in the next 15 or 20 years. So what are these European pension funds going to do if they have interest rates that, they bought bonds at below zero?
The problem with politicians. I wrote in 2009, 2010 an article in the major paper. I says this is a time to go back into stocks because the cycle bottomed in 2009. But of course, everybody was afraid, and the politician did not allow the pension fund to have a big amount of stocks. So there had to be, I think, a 70% bonds. So they're still in 70% bonds, and they bought bonds even when they get negative interest. So now they're using a lot of capital. And the problem is that the politicians and the government decides how much percent they can be in every asset, and they have no clue to go against the wave.
What is going to happen? Because now, as the baby boomers, I mean, you're my age, you're going to start, instead of adding to these pension funds, they're going to start subtracting from them. They're going to start using their benefits. So they're going to be taking their money out of the pension fund, and the pension fund will probably have lost an awful lot of money from these, because I understand they have 70-80% of bonds in Europe. It's going to be a terrible, terrible situation.
Well, that's the problem with all the people who thought I'm safe and I'm going to stay in bonds. I don't know. Already people had a problem because they were in stocks because they get no rate of return in the bank, and now they're losing in all markets. So it's going to be very, very tough for for people to retire.
So this is another long-term chart. Now this is from the August of 20 is where you said it looks like this is pretty much where we peaked, and it looks like it's down. Is this the bounce that you're talking about that we're going to start looking for right here?
Yeah, but on the weekly chart, it's still a couple of weeks away.
But it's coming.
Yes, it's coming. Maybe it started already. We started to buy bonds. I just have to see if I get an upside price target. So you asked me what can people do? Well, you have to become a little market timer, because I think it was a setup by institutions for years to say just hold for the long term. Because if people hold for the long term, the institutions can sell because they have to sell to somebody. And please don't listen anymore to the long term. What you do is, I just tell this because I see you as friend. People can go on my research and have it 4 weeks for free, at least to get an idea how investors that really know what's going on approach the market. But you have to do something. You cannot just sit and let your money disappear.
Well, I'm so glad that you're doing this, Charles, because honestly, a lot of my clients, people I interact with, they're just a little lost. They're just a little bewildered. Really don't know what to do. And literally last week, you would have saved them tens of thousands of dollars just on a one-day call that you had with
Well, not that. I remember that like half a year ago, we talked about people that you work with are in real estate. What can they do? I said, let them buy some put options on Toll or Lennar. Almost nobody did it, but the people who did it made, I think, 2,000% profit. Well, it was amazing.
Talk about that. Let me go to my next slide, because I think we've included those guys. You're absolutely correct. Another great call for you. So let's take a look here. All right. Well, here's Lennar, and you certainly did. So
I did some work for people who are not totally convinced that cycles work. So as you saw in the Dow Jones, the 3 cycles, sometimes they're more, but this is the major cycle that moves Lennar. And what is interesting is from high to high to high to high, it's the same amount of weeks. So it has not too much to do with what the news is that comes out, because when it's a cycle top, it has to top, and when a cycle bottom is, it has to bottom. So even for people who are in real estate and they want to hedge their portfolios, they only have to know this cycle. What they do is they hedge themselves when the cycle tops, and they take off the hedge when the cycle bottoms. So I made this especially for our discussion, because this I guess is very clear that there is a regularity. It goes regular, the cycle. Now, if you want to fine tune it, I have to bring in other cycles, but then it's not as clear as this one. So this one, according to me, is clear that every so many weeks there's a top and a bottom. And listening to the news or being an investor, you have no clue if it's going to come or not, because you don't know what the news is going to be. Let's say 6, 7, 8 months out when the next cycle top appears.
So what's the implication on this one, Charles? Is this saying that now, we have real estate's a separate asset class. Now, Lennar is in the real estate business, but we're looking at Lennar, which would be an equity, but it's still a business stock. So can we extrapolate this to anything? We can see what's happening. Will this lead over into my asset class?
Yeah, what you see is the long-term cycle, the dominant cycle is down, I think, for a year and a half. Probably going to get some bounce again, but real estate doesn't look good, because this same thing happened in 2006. If you go to my website, you see I was on CNBC in 2006, and I says, you better get out of real estate. The whole thing is going to collapse. And part of it was based on the fact that Lennar and Toll Brothers, which you also will see later, came down strongly, and the insiders already sell. The owners of the houses and the real estate don't really realize what's going to happen.
So is there a lag time between your cycles and in the real world in Lennar? So would Lennar's equity reflect into the real world at a lag of 6 months to 12 months?
Well, that you can know better than me, because you in the middle of the real estate, and if you see when a cycle tops and you look at the real prices, then you can see what the lag time is. So the last time the Lennar started coming down, I think in 2006, and then things still looked okay. And I don't know exactly when the collapse started of the real estate.
Well, the collapse in real estate was started in 2006. So actually, it had a double peak. It had a peak in early 2006, and then it seems like it had a double peak, but all the momentum was done, and it double peaked again. But there was really no selling. There was no volume at all. There was just some latent pricing, but all the pressure was done in the first peak. But I do a little bit of timing, nothing like what you do. And my timing model says we still have another 12 to 18 months. So I don't know if that's a lag or if I'm just wrong in my cycle. So because we're really strong here. So we're here in Phoenix. I mean, you can't get enough properties. We just don't have enough properties for the people who want them. We just don't.
But I tell you, in 2006, I had a cleaning lady who almost didn't make any money, and she bought a very nice house. The bank gave her all the finances. So I'm not that quiet. I think this housing market will not hold up with these stocks looking like they are.
Okay, that's what we need to hear. So you think the market are done? So this is going to go multi-assets. So the next.
So my advice again is, if you see a bounce also in Toll Brothers and Lennar, watch for the cycle top. And now, if you didn't do it, please buy those puts, and you're totally covered.
Perfect. Let's make sure we said that, because everyone understands that. So in your work and in mine too, it shows that we have some real turmoil coming. And let me go on the next slide too, because we've got a couple other slides that we want to get through that will maybe illustrate this. Here's Toll Brothers again, and we're talking about the same type of cycle. So we have two in the same asset class. Both are experiencing the same type of drop. And of course, this is real world being reflected in your cycles. So again, same type of, I'm going to assume the same type of advice. It's time to really start thinking of an exit strategy or what you're going to do. Is that correct?
Yeah, so this should convince everybody that there is an important cycle. And then it should also convince people that there are more cycles to fine tune it. So the much longer term cycles, the shorter term cycles. But first, I want to make clear that it's very hard to decide that this doesn't work. That's why I made these cycles for people who don't really believe in it.
So the question I have, when we have the governments, can the government change the cycle or accelerate it, or
no?
They can't.
Nothing. That's an interesting thing. I remember in the old days, well, it's not the old days, that Greenspan was testifying in Congress, and he talked about the business cycle. And he says there's a 4-year cycle also in the stock market, and it cannot be changed. There's nothing you can do about it. Now, if you maybe remember that a lot of my work is based on the sunspot theory, the sunspot intensity, and the sunspot cycle is 11.5 years, and the business cycle is 11.5 years. You talk here with the laws of nature that you cannot change. Now, again, if you think that humankind can change reality, then you can never predict anything. And like people that work for me used to talk to hedge funds and says, if you know something better than me, then use that. But there is nothing better than this. So then you get the question, do you think it's always going to work? I say, I don't know, but for the last 40 years, it's working fine. And who knows, maybe it continues to work. And if not, then we'll know by that time. It's just a law of nature. That means that when a cycle tops, a government, whoever is going to make a decision that later will say, oh, there was a bad decision, and that's why Toll Brothers came down. And if there's a bottom, then they're going to make a good decision. And we say, oh, that's why the stock goes up. It becomes more complicated and more of a mystery when you talk about a forecast for wheat, sugar, cocoa, lumber, because we don't know what the weather's going to be. And the weather always follows the cycles. So it's still something open to be discussed. Years ago, I said, when I retire, I'm going to write a book about it, but I don't think I'm going to do it. I'm too lazy. And
you're not retired.
And I really don't know what the answer is. How can my computer know how wheat prices are going to function? We were long wheat because the multi-year cycle was going straight up before they invaded Ukraine. And when they invaded Ukraine, everybody says, oh, now we know why wheat goes up. But it was already up for a lot. And, I don't have an answer. I'm happy that it works. I'm happy for my clients that it continues to function well, but I cannot really explain it.
Well, so the implication would be, let's just talk about Toll Brothers. So if you're representing a builder and you look at the chart and the chart's saying, hey, look, it looks like it's going to fall right off a cliff here. It's going to be really, really soft. It's going to be really bad. And we looked at your triple cycle where it's showing the three of them coming together just like it was in 2006 and 7. Well, then if you're a builder, you're going to say, well, then maybe I should not buy all this land and start developing.
As a builder, you have to know where interest rates are going, and you have to know where lumber prices are going. Problem is that the bank doesn't tell you that knowledge is available, so you don't look at these things. But you can make a total calculation. You know, they make calculations on the price of today, but that's not to make a calculation of when they're going to start and how long it's going to be and how much lumber I just give an example because I work with the Canadian banks that give out a lot of loans for people who are in lumber. So you have to know how long the lumber price goes up, when you should buy it. Maybe you have to buy a contract 4 months earlier when the price is low, but you have to know then what the cycle is, if it goes up or down the lumber price. So you have to know a lot of things.
Well, it's perfect for this. I was thinking of this beforehand because this really gives you some forward planning. It's just great. Knows when you can put more emphasis onto what you're buying, when you should add, when you should be aggressive, and maybe when you should be cautious. It works beautifully. Let me go to the next slide. So this is just another illustration. I put this in as Facebook. So did you not exit this at 326? Is that correct?
So the question is, Facebook came down strongly based on bad numbers, even before the markets start coming down. So how did the cycle know that the numbers are going to come out bad? So the question is, were they bad or were they interpreted bad because the cycles was down? I once gave you the example, if you buy IBM at 100, and you hold it for a year, it goes 150 and the numbers come out and the numbers are great. If the cycle is up, then the stock goes up and the Wall Street Journal will write, well, people poured into IBM because they're doing great. And if the numbers are great, but the cycle is down, so the stock goes down. So what did they write the next day? Well, investors took profit because they don't think they can do better next year. So it all has to do with psychology and interpretation. So I am not good enough to tell you if these numbers were really that bad. But like we went out in 326, and right now, since there's a cycle low, I said, well, if the market holds where I think it's going to hold the NASDAQ, then people can start buying back some Facebook, but only for a bounce. It's not going all the way up, but for a bounce because, you know, they sidestepped like $130, $140, so they want to get back a little bit.
Well, and you always say, Charles, we don't really know why. We just know what is going to happen. It's much more important to know what is going to happen. You know, I don't care why sometimes. But the implications is just enormous on a lot of these. So if you can start seeing this and you can start correlating. So we've been talking about the fact that the Dow Jones looks like it's going bad. We've got inflation's going up. We got housing coming down. And we got some stocks coming down. It sounds to me like we've got some rocky roads right in front of us. Let me go to my next slide here. Here's the U.S. dollar too. And I've been watching this, Charles. Even I haven't talked about this, but you know, when there's turmoil in the world, the United States dollar seems to get an awful lot of strength to it. And here we are, we have inflation in the United States, and we have a strong dollar. So I concern them, what happens, you know, because the dollar is going to cycle. What happens when the U.S. dollar decides that it's time to go down? What's going to happen to inflation? Because everything is, you know, so if it's quoted $100 for oil in U.S. dollars and the dollar softens, it could go down to 90 U.S. dollars, but oil would go up to 110. It'd be the same thing, just because the dollar.
It will make inflation even worse.
Make inflation even worse. And this just goes to what you're talking about, that we're going to have long-term inflation. So are we talking about maybe the U.S. dollar softening up considerably?
Not right now. Not right now.
So, you know, we've had some of these spikes. I think this is probably somewhere in the 2001, 2002 area. I think the U.S. dollar went up on the DXY to about 122. And today I think it's flirting with 104. Right. So it's still got quite a ways. Do you think you get back up to the cycle high?
Yeah, I think it looks bullish. No, they have been complaining about the dollar, and everybody's expecting the dollar come down, but we have been positive on the dollar, and especially if interest rates stay at zero in Europe, there's no reason to buy the euro, just from a fundamental point of view.
Can you imagine like being in Turkey where they've got inflation, their lira is just kind of falling apart. They've lost 50, 60, 70% of their purchasing power. And then they have the US dollar getting stronger on top of that. The inflation in some of these countries would be off the charts.
Well, it's just a precursor for having more problems in the world.
That's the implication of this, isn't it? Because it's going to cost everything. You'd be working, and your dollar doesn't buy anything.
And food prices are going through the roof.
Correct. So we still see food prices going through the roof. We see the dollar going higher. That means that the oil's got to be going up as well.
Well, short term, not so much anymore. I think for the moment we saw most of it. The same thing for natural gas. I wrote a whole article about it because it's always natural gas goes up. I think we bought it around 2.5 or so, and we went out at 8.40. That was the sell signal. But the people think it goes to the roof always, and it's very hard to get them out when things are going well. But for the time being, again, I think things will soften a little bit.
Well, that's been my outlook too. I thought we were going to have some moderation in inflation. I didn't think it was going to go away, but I thought it was going to moderate. How long do you think that the Fed's going to continue raising interest rates on us, Charles? Does it look like they're talking like multiple increases? The economy is already softening, and it's reacting very negatively, very quickly. Do you think they'll continue with their increases?
I think they don't know what they're doing, so that's why I cannot predict what they're doing.
Well, that's I like that. That's a good one. I like that. Let me go to the next slide. So this is the agriculture. Again, it's just a perfect shot. So you're talking that in July, it looks like if you're going to buy wheat. Now, if you were, say you were a bread manufacturer or you made pizza dough, this would be the time you want to buy some wheat. Is that correct?
Yeah, but isn't it interesting with this cycle? So if Biden says, these things happen because of Putin, it has nothing to do with Putin because the cycle is up anyway. It's very hard because everybody has a self-interest. There was, give you a little history to explain it. There was Professor Schumpeter, who really believed in cycles and in business cycles, and he predicted the crash of 1929 also. And after that came Keynes, and Keynes said, well, if we take care of the money supply, whatever, we're not going to have a new crash. So if you're a politician and you say, well, I adhere Schumpeter, why will people vote for you? Because you cannot do anything to change the history. So you go after Keynes because then you can do something. So that's why politicians have to make up these stories, because if you say, wheat has nothing to do with Putin or whatever, right? So then they have a big problem because what does it have to do with?
Right.
And then what are you doing? Because then you, Mr. Biden, you cannot change history because it's going the way it's going to go anyway.
Well, they always want someone to blame, Charles. So I guess this is cut in stone. So anyway, we see wheat bottoming soon. Is this going to be a very long bounce with the prices coming back up, or is this part of your inflationary cycle right here?
I guess wheat is part of the inflationary, but most of it is still natural gas and crude oil.
So this would be a good trade for some coming. Do you know how long this bounce is going to be?
No, I didn't calculate that. I just made the chart to give you an idea. But if people follow the research, it will tell you exactly how high and when the bottom is and when the top is. We publish 4 times a week with the exact dates and exact levels.
And here's copper too. We put this one in because it just didn't get any more explicit than these last two.
This, for instance, I told big investors not to trust the second top because the cycles were down. And as you see, the cycle was a little bit up, but not very much. So now copper is down. I have to take a look on the left side. You see it into July. So we might see a little bit less inflation if these things come down for a couple of weeks, a couple of months.